Dear traders, in today's video tutorial, we'll talk about correlations. That is, correlation is a kind of relationship with other instruments that can influence each other and more synchronously. We will talk about the types of correlations and tools in the next video. In this video, I want to give you a starting point so that you understand that correlations can be violated, that synchronization in the movement of instrument to stop for a while, although they have stable long-term dynamic. Such temporary deviations can give you good options for a more detailed analysis and get an important signal in advance for making a highly probable deal. As always, I prepared illustrative examples from real trading to make it visually clearly for you. Okay, look at the chart. Look at the two graphs in figure 1. Nasdaq 100 and S&P 500. If you superficially evaluate and connect the usual logic to this, it might seem that there is a complete correlation, and this seems to be the way it should be. Both indexes reflecting the movements of hundreds of stocks included in them. Especially in the modern world, the dense correlation of indexes from west to east is not surprising. The issue is more of a global external background and risk appetite. Moreover, both American indexes, where the constituent assets somewhere overlap, somewhere just in the direction of the overall market picture. In addition, after listening to the financial news and reading analytical publications, most likely a trader will reject any option for a buy transaction, and this decision from the outside may seem quite sensible. The external background is negative, the technological index is under pressure, and the S&P 500 will be quite crushing. But in fact, one must be very careful about correlations, and sometimes they give chances to work ahead of the curve from a weak or strong side. Read the chart and not succumb to the generally accepted logic. I will show you on the example of transactions made the other day in order to visually explain how this happens in practice. Figure 2. So, the first deal was opened according to the technological index, a powerful uptrend globally, sellers pressure locally, but the price is suitable for a test 13,401. You see, uptrend at the weekly chart. I agree that on the 4-hour chart, you see 4-hour chart here, the trade may look very risky because the pressure is still ongoing and there is no visually clear retention limit base. But here is the point in the key price and even more detailed analysis on the 15 minutes and 1 minute chart, where the picture of the reaction is revealed more fully. So you see 4-hour chart, and here you see key points here, here, and here, but no clear retention on the 4-hour chart. So let's look at 15-minute chart. Here, 15-minute chart. On the 15-minute chart, everything looks not so scary as on 4-hour chart. Here you can already see the struggle around 13,401. There is consolidation, which means there is pool for movement and probability for the mathematical part. It is also important to pay attention to the nature of movement of the instrument. Even in the pressure continuous, there are high chances of reaching break-even as it already at 13,558. Let's look picture 5. Here you see 1-minute chart. But on the 1-minute chart, the situation becomes even more readable and absolutely clear, holding at 13,375, a false breakout, and again holding a cent in cent. Let me explain. Here, key point. False breakdown and clear retention. At the same time, note that the generally accepted rule in the trading world is to buy above the level and sell below the level. Here, as it were, is overlooked because the purchase is below 13,401. So this rule does not work here. Buy above the level, sell below the level. In the case of trading with such liquid instruments with limited volatility, the main task is the mathematical part, namely the chances of movement in medium volatility and the ability to set a short stop. If I entered here about 13,401 about the level, the stop was already out of proportion to the potential in terms of the instrument's daily volatility. That is why for me the global level is a reference point, but it is much more important what the instrument does locally, where the reaction takes place. Is it sufficient, and is there chance for the mathematical part? Picture 6. This is followed by an impulse and stop loss at break-even, you see, from here to here. Because in case of a return to the entry point, the opposite scenario of a false breakout of 13,418 and an increase in pressure on the instrument is realized. You see struggle at 13,418 and false breakup. That can break my scenario. Picture 7. The situation becomes more and more undesirable after the instrument failed to pass 13,417 and failed 13,412. Here the chances are already scanty for the continuation of the upward movement, but so far they remain, and the mathematics of the trading approach is not implemented. I can only observe here. You see, false break up. As a result, the transaction is closed at break-even. Picture 9. Now look at the 15-minute chart and how the instrument still went below 13,000 375, where many more times most of traders tried to re-enter again, and someone tried a breakdown by short selling, then a false hope for breakout of 13,433, and then the final fall. So here are a lot of problems who try to re-enter again and again and again, because some part of traders try to sell short, some part of traders try to buy long. But if you see that your scenario doesn't work, please, you can leave this idea alone. But this is the skill of a speculator trader who knows how to reorganize in time, leave an inoperative or dubious idea, and find something worthwhile. Remember, we are not at war to push against the market and stand our ground to the last. In the chart 10, you can already see the technology index in free fall. And exactly where I started this webinar, the question arises: is it possible to get a strong buy idea for any instrument with such an external background and tight correlation between the indexes? In most cases, no. And the trader will further abandon all long ideas, now trying to follow the trend. Trend is your friend, isn't it? So the tech index is plummeting. We can say that I went into a steep fall. But it is worth looking at what is happening along S&P 500. Let's look. Picture 11. But what happens at this moment on the 1-minute chart of the S&P 500? The instrument following the tech index breaks through 387.20, but below the impulse does not pass, even despite the continuing pressure in the tech indexes. Instead, I see a consolidation that seems to speak for itself. In the event of the slighted suspension of sales on the tech index, a solid short squeeze reaction to S&P 500 can be expected. So I will show you visually here. So as I wrote, a very interesting reaction. Again, the background of falling technological index. At this moment, technological index still falling. S&P 500, a sluggish breakdown of 387.20. And consolidation. Probability behind an attempt to buy off and energy at the expense of short sellers. So if technology index will correct a little bit, here we can expect strong movement and short squeeze. That is correlations that you can analyze. Picture 12. Here comes the expected impulse, which allows you to move the stop to break even. By analogy with a deal on technology index, a return to the entry point will already be highly undesirable and may create a new wave of pressure on the instrument. So But there should already be an expected impulse from such a consolidation. So the stop loss is at break-even. You see, entry points, stop loss, and at break-even. Because here I expect impulse with the cause of short seller. Okay, picture 13. On the 15-minute chart, you again see that the trade was open to the level. Here the local picture and correlation were important. It's 15-minute chart. Key point. You see the struggle at key point. Looking ahead, I will say that taking into account the external background, I took the mathematical potential and I failed to take the lion's share of the movement. Everything went as if by notes until the gap was closed according to the scenario up to 389.5, from where the instrument was redeployed. In such conditions of the external background, one has to keep an eye out, which has borne fruit more than once. Then the instrument was turned sharply, literally only after the timely exit from the deal. Picture 15. In a positive scenario, we can expect growth to 389.5 to close the gap, you see. At this moment, following a new wave of pressure on the technological index, I decided not to risk the accumulated profit on the S&P 500, especially since the main goal, the mathematical one, was achieved. It's a very dangerous situation. So, full fixation, the mathematical part, and more is achieved. Entry points, fixation, add into position, and full fixation. It is possible to enter again from 387.75 with this consolidation. So at this point, it was possible to try to enter again, but did not like the correlation pressure on the technological index I showed you. So, but here apparently the previously manifested increased concentration and already a decrease in risk appetite had an effect, especially since technological index demonstrated an extremely vulnerable situation. So you see, after the false breakouts, there are still no active purchases, which confused me. As a result, you see that a colossal part of the movement has already passed without my presence. Perhaps you are already asking yourself the question, how could you have missed this movement, having the entering position with jewelry? Was it worth it to be so careful? Okay. Exactly the intended target. There are situations which have been repeatedly before when a small impulse can be recorded in time, and the majority of such situations. But today, there was a trend day from the bottom of the market, and such situations happen no more than 5–10% of all cases. Of course, it might and should have held at least 15–20% of the position. But I took my plus, and that's good. So you see that Lion's part of this movement without me. Okay. Now look at the post-factum moment in figure 20. That is why I had to be on my guard all the time in order not to miss the accumulated profit. Exactly, after the fact, one can hear clever comments that it is possible to buy an excellent 387 here. Then drop at 389.6. Buy, sell, and roll over at 389.4 for short sale. But you know, that is the difference between real trading and paper trading post-factum, and clever analytical analysis, where to buy, where to sell. It's all post-factum. So your work with real risk and mathematics, and the main task is not to show a beautiful deal at 100-to-1 profit risk, but working mathematics and growing your deposit. Such situations of increased volatility are both good for potential and at the same time bad for psychologically unstable traders. When after a break-even or unprofitable and even worse unprofitable series of trades, a trader literally breaks the roof, burying tilt trades in a devastated deposit. So in real trading, most will buy here, and here he expects that trend will follow. So this fixation is not a problem. The main goal, your mathematical part. In conclusion, one more deal with S&P 500 in response to the question of why you have to trade with extreme concentration and show increased caution at the first signs of risk for a trade, preferring the mathematical part rather than dreams of cosmic potential. S&P 500 buy from 319.10, and an addition from a sluggish pullback to the mirror level 390.50. With a timely fixation at the local resistance 391. So I think I managed to slightly open the curtain on how to work with correlations. In the next video, we will see a little more fully exactly what correlations can be and how they behave in global markets. In this video, it was important to show that correlations do not always work, and you can use this to your advantage. I hope you like this video, and see you soon.